What's going on, everybody? What is going on? James Hollingsworth here. Welcome to the Working People's Podcast. Happy Father's Day. How's everybody out there enjoying your day today? Well, happy Father's Day. And this is the Working People's Podcast where everybody desires to build generational wealth and a financial legacy for their families. And today we're going to come and just do some market evaluation and analysis and try to determine and answer that elusive question. Are we headed for a total economic and market collapse? Is it, is it just a matter of time before we see the bottom fall out? I mean, there's a lot of people on social media platforms that's teaching different things and have different thoughts and opinions about it. But I like to look at data, and I like to look at numbers and historical data in particular because it tells a lot, right? When you're looking back at history, it's not to say that historical data or things is indicative or representative of any type of future performance, but though that data does tell us a lot about patterns, tells us a lot about maybe different trends. That's a good way of putting it. Data and different trends. So I'm going to look at some historical data and try to determine, you know, let you decide for yourself. What do you think? Some people already think that, we're on the verge of seeing one of the biggest market collapses in the history of our country. In fact, I heard a gentleman say last week, I think it was last week, he said that with the housing market, he said when the interest rates went up, that must have been this week. Sorry, I don't know, this week. He said that when the Fed raised the interest rates and interest rates on mortgages went up, and I think he said like 6.5% is where they were at or whatever. I haven't actually looked at to see what the current rates are because those rates change anyway. And so he said that it was the worst he had ever, worst that we've ever seen and had in the history of our of mortgages. And I'm looking like sideways and cockeyed because come on, bro. So I might even look at some historical data on mortgages and show you that in the early 80s there was a time when we had mortgage rates that were 16, 17%. In fact, the Fed rate was like 20, 21% because we were going through an oil crisis at the time. So, uh, and this guy was about, middle age. So he's been around. I'm sure he was alive when that was happening. I mean, unless he just totally forgot, that happened. So we're gonna look at some numbers and stuff. But I also know that some people are struggling right now because the CPI index, the number for inflation is up to like 6.8%. I'm sorry, 8.6%, and it is pretty high. So the cost of certain items and things have certainly increased. In fact, let's take a look at that. Let's go here, share this with you. So naturally, the cost of food, the cost of gas, um, and just a number of household items have increased. So it is a very tight time that we're in right now, a tight time, especially when you're talking about people that may be on a fixed income. But I also got a couple tips, when it comes to making large purchases and just standard household purchases and things that most of us have. There's so many Americans that have mortgages and house payments and car payments and things like that. So I want to look at that, right? Let me see if I can should switch my screens over. But I should be good. You'll just see the next screen as it comes up. I should have switched you over to the other screen. I don't know if I can do that. Let me see if I can do that. Swap present view. Here we go. So that should switch you over. Okay, so this is from the last 12 months with the inflation numbers that we've been seeing. This is data from the Bureau of Labor Statistics, BLS. You can see that the price of meat and poultry has increased by 14.3%. Fruits and vegetables have increased by 7.8%. Airfares have increased by 33%. Used cars, oh my goodness, have increased by 22.7%. And gas, the price of fuel, has increased by 43.6%. This is the impact of inflation on our everyday life, right? So I know that a lot of times, we just came out of a time where we experienced some of the lowest interest rates, like for mortgages. The Fed rate was, pretty low. Some of the lowest interest rates that we've seen in the history of our country. And what tends to happen is when money is cheap to borrow, that's exactly what people do. They borrow money, and they usually will borrow money for things that are not needs, are not necessary items to have. Oftentimes, we'll spend money and borrow money to buy things that we want. To buy toys such as boats, motorcycles, RVs, jet skis, snowmobiles. And recently, I don't know about you all, and wherever you're watching from, I've seen a lot of RVs for sale, motorcycles, boats for sale, and so naturally, our lives with the cost of inflation, has drastically changed our ability to pay for some of those luxuries of life that we would like to have. And if you're talking about airfares that have increased 33%, then naturally, yes, you got to make some decisions and choices. Do you want to take that family annual trip, this year or last year, like you would normally take? Or do you want to maybe delay it a little bit and save up a little extra money in order to be able to go on the trip and then come back home and not be burdened with your cost of your daily living expenses, because maybe you spent some of the money, excuse me, that you would have normally allocated toward those bills and things like that. So there are some recommendations that we see. Now, let me back up just a little bit. As I've mentioned in my former life, doing, being in the financial services field, what I was a part of was comprehensive financial planning, right? So fee-based financial advisory and financial planning, which basically means you can charge a fee to help to develop a comprehensive financial plan, which includes a budget, uh, to try to assess do people have discretionary income, and if that's the case, kind of set up a budgeting plan. You find out what their goals are. You do a risk assessment and a risk analysis. You do this comprehensive plan to try to determine what their goals are. If they want to retire, if that's the goal, or trips, or buy a house, whatever that case may be. And then you set up a plan on how they can get there. Then you look at also their protection needs. Is income protection needed through insurance? Or do you want to also at some point use this insurance and convert it to some type of permanent policy where you can roll it over and use this to pass on um, the inheritance to the children with the least amount of tax consequences as possible? So you look at protection needs. Do they need an umbrella policy to go over top of their the homeowners and their automobile policy? Just look at the comprehensive financial assessment is what you're looking to do. And so because of that, there's a lot of times I look at more than just how to invest in stocks, or how to, get into a good mutual fund. Certainly some of those things, will be a part of it. But now we're talking about if you're going to get into stocks, how to build a comprehensive, diversified portfolio with certain stocks that would make sure that you meet your goals, as well as that matches what your risk analysis or your risk assessment tolerance is. So when we're talking about people tending to buy more stuff when money is cheap to borrow, you got to realize that just because the interest rates are low, they're not going to always stay that way, right? So that's important to understand. So from May 2021 to May 2022, the consumer price index for all urban consumers increased. We see the inflation rate 8.6%. and this is the largest 12-month increase since the period ending in December of 1981. So that's an important number to look at, right? So when we look, well, let me get out of here first, and I want to look at the historical data for inflation. There we go. All right, sorry about that. Trying to switch these screens over and everything. Oops, and I shut the wrong one down. Sorry. Oops. So, uh, table of historical inflation rates and percentage. So let's go down to now, mind you, deflation is just as bad as inflation, right? Deflation is just as bad as inflation. So if you have periods of negative inflation, those times are just as bad as high inflation. So click on this right there. And let's look at the years of, I mentioned 1979, 1980, 1981 in that time period. So in 1979, there was an oil crisis and the inflation rates went up to 11.3%. In 1980, those inflation rates went up to 13.5%. So those numbers are staggering, right? When you consider it. And I'm going to share show on stream. There we go. And in 1981, inflation rates were 10.3%. So for a period of 3 years, I mean, you can even go back to 1978 and inflation was 7.6%. So for a period of 3 years, we had inflation, rates that were in the double digits during that time period. So, and in fact, look, all year long, from January in 1979 all the way to December, inflation continued to increase until December was up to 13.3% in the month of December. 1980, you're looking at the year started off at 13.9%, and it steadily increased. It kind of dropped a little bit, but on average, for the year of 1980, inflation was at 13.5%, 13.5%. And then in 1981, you look at inflation started off the year 11.8%, and then for on average, inflation was 10.3% during that time period. Let's come on down here to, let's look at 2008 when we had the housing bubble. Well, inflation really didn't take off and increase that much, so it wasn't really out of control. But then you see the next year where inflation, we suffered a point of deflation with negative inflation. And mind you, like I say, deflation is just as bad as inflation. It can also cause problems in price indexes and items possibly increasing in price. And so there were things that was put in place. We know about the stimulus packages and all this other stuff that happened, the bailouts and things. So inflation came in 2009 in negative numbers, but in 2010, 1.6%. Until we get to this year of 2022, and we've seen, as you start looking, you start seeing inflation start teetering up over the 2% mark in 2017, teetering up, dropped a little bit, dropped in 2020, and then all of a sudden, 2021, how much COVID played into it? It's hard to say, right? But then in 2021 to 2022, we just saw inflation, the CPI, the Consumer Price Index, and numbers just starting to increase exponentially. Started off the year at 7.5%, and then in February 7.9, March 8.5, March April 8.3, May 8.6%. The new numbers are supposed to come out in July the 13th to determine what the current CPI, Consumer Price Index, and inflation numbers will be. And at that point, the Fed will probably, I'm guessing it's not going to be any type of sharp decline that we're going to see. And I'm guessing that the Feds are going to raise the basis points again on the Fed rates, on the interest rates. And it would be my guess that they probably will go up a minimum of another 50 basis points. And quite possibly, I wouldn't be surprised if we see an additional 75 basis points in the Fed rate. So let's look at some historical numbers. Some people said we're in a recession. Are we in a recession? According to the S&P, we're definitely in a bear market. So the 2022 current annual change, we're declined almost 23% for the year up to this point. And 20% or more is definitely bear market, definitely 100% bear market area. So, if we sustain these numbers like we're doing now with this decline, then we can definitely, without a doubt, say that we are experiencing a recession. The S&P down 22.9%, almost 23% for the year. So that's a pretty steady decline. If you look in 2000, I like to compare 2008 because we had that time with the housing market bubble and everything. Look in 2008. Look at the S&P. It dived nearly 40%, 38.49%. So we had a bad year that year in 2008. The market really stumbled, and definitely we experienced what was called the Great Recession. We sustained those losses all year long, and pretty significant downturn. I'm gonna go back over here and show you something to look at real quick. This one right here. So the market in October 2007 to November 2008, the market saw a sharp drop of nearly 52%. Good Lord, that's a lot. With the bear market lasting for 408 days, this period is known as the Great Recession, and it's when the housing market collapsed. The GDP contracted 3 quarters in a row as unemployment rates jumped to 10%. Now, I think everybody needs to start thinking and realize that if we sustain these sub 20% numbers over a sustained period of time, You could begin to start looking and seeing possible layoffs, some scaling back and tightening in the job market. Um, and I don't think that inflation is going to take the kind of downturn like we some people are maybe expecting this year. We probably won't see any type of decent inflation numbers until the end of next year, 2023. And even with that, keep in mind that prices, they don't tend to follow, uh, parallel tracking with that, right? So it's probably going to be a while before we see any type of price reductions and prices on things leveling out. We might see it in fuel, we might see it in that area sooner, but when you start talking about food and the cost of other type household type items, airline tickets and things like that, we're probably going to see those prices sustain its current values or prices. We're probably going to be looking at these kind of prices for a while, right? Then we had another extensive bear market time in 2020, February and March, where for about 33 days, I certainly remember that. I remember those 30+% downturn in the market. It seemed like every week the market took a quick dive for a few weeks. So this short bear market that lasted only 33 days, but saw a drop in the market of nearly 34%. The COVID pandemic wreaked havoc on the economy with an economic contraction of 31.4% in the second quarter. This was the second quarter it fell, dropping 5% in quarter one. And unemployment, look at that, unemployment jumped to 14.7% in a short period of time. So looking at these type of downturns in the market, we can see, in fact, 2007, 2008, and 2020. So let's take a look and see 2008, 2000, let's say 2010, 2020. Oh, Lord, what did I say? Well, I looked at 2008, 2007, I believe it was, 2007, 2008. So we see where the market was at. Let's look at 2020. 2020. Oops, going the wrong direction, y'all. This is the S&P 2020. There we go. 2020, we ended up with an annual average gain of 16.26%. So that's good. That's good, right? You can see each year, we had moderate losses in 2018, negative 6.24% in the S&P. Prior to that, we had some good years. So let's look at when we had that bad year in 2008. You can see that in 2009, the following 2 years, how the market rebounded. It rebounded substantially in 2009 at 23.45%. And in 2010, we had gains still in the double digits of 12.78%. Even looking at 2011, when we had no gains on the S&P, came out at 0%. You can look the following 3 years, we had gains, 13.41% in 2012, 29.6% in 2013, and 11.39% in 2014. Then in 2015, when the S&P had negative returns of 0.73%, once again, the following year, 2016, the market rebounded 9.54%, and in 2017, 19.42%. So looking at the S&P, when you say, well, good Lord, are we headed for a total economic collapse? Are we about to experience, the bottom of the market falling out? The historical data tells us that even if that happens, look at 2000, 2001, 2002. We had 3 really bad years. I mean, I would call that a recession. Well, technically, they say it wouldn't be until numbers exceed 20%. But definitely, this is bear market, territory. But, you got double-digit losses for 3 years, negative returns. for 3 years, I would probably even say, yeah, a recession. Look at that, 2000, negative 10%, 2001, negative 13%, 2002, negative 23.37%. So those type of sustained losses for 3 years, but then look what happened in the market for the next 5 years. The, the, uh, the following subsequent year of 2003, market rebounded 26.38% and sustained growth, green numbers for the next, 4 years after that. 1, 2, 3, 4. Yep. So personally, I mean, yeah, do the evaluation. What do you think? You know, I know a lot of people, especially certain people in certain financial analyst areas, that they specialize in. You got a lot of the people that are bullish on, Bitcoin and other types of cryptocurrency. They're always going to be hollering, the stock market and the economy is headed for a total collapse. You got some other people that believe that you shouldn't be putting your money in 401ks and company sponsored plans and stuff like that. They're going to always be screaming the same thing because they're the real estate investor guys, and they're going to be telling you that, stay away from the market. The market's going to totally collapse and the economy's, the dollar ain't worth this, dollar ain't worth that. But, how are people paying you rent? They ain't paying it to you in chickens, they're not paying it to you in pounds like back in the day, years and years and years and years ago. The old preachers would do their circuit around, through the different towns in Arkansas and Mississippi, and poor folk, they didn't really have much to pay them, so they pay them in groceries. They pay them in some collard greens and some chickens, and maybe give them some baked potatoes or some corn. So I mean, for the financial, real estate people that are saying stay away from the market, don't put your money in your 401k because the economy is about to collapse and the dollar ain't worth much. It's I can't say the words that they use, but it's worth pennies and this, that, and the third. Well, they ain't expecting you to pay your mortgage. I mean, pay your rent to them, with collard greens and black eyed peas. So, even though, you probably could pay me in some banana pudding if it's good, or some, peach cobbler. You could pay me, probably have to give me a lot of peach cobbler though. So even if we look at the Dow Jones Industrial Average, for this year, we're down almost 18% for the year, So it is what it is, right? And these numbers will probably pretty much coincide. Look at 2008, negative 33.84%. So, but then after that, the Dow Jones showed gains in 2009 of 18.82%, then in 2010, 11.2%, and it had positive numbers for 1, 2, 3, 4, 5, 6 years straight from 2009 all the way into 2014. So I just don't, see, necessarily where you're talking about a total economic collapse. That's, to me, a little excessive. Yeah. So let's go back to here. So here's the thing, when it comes to our personal finances, I mentioned about, a lot of people having to put their boats up for sale and RVs for sale and motorcycles. I've seen a lot of them in Michigan. I don't know about where you're living right now, if you're seeing people put some of their toys up for sale. Because like I said, money was cheap to rent, cheap to borrow, and the banks were giving it away pretty loosely. Here, take, here's some money. Who wants to borrow some money? Who wants to borrow some money? And they was just dishing it out, and everybody was just going and grabbing as much money as they could. Bank was giving it away. So, hey, I'll take that. I'll take that money. How much you gonna loan me? So, typical finance, if people are doing their job in the finance area, here's the problem. Let me tell you what I think is a significant problem. A significant problem is when people want to sell you something because they are going to make a commission off of that sale, and naturally off of that sale, their commission is highly dependent upon the cost of whatever they're selling you. So the more it costs, the more commission they make. So naturally, people are not going to necessarily be concerned about your debt to income ratio and your percentage as it relates to how you're going to pay your bills if you go out and borrow money to buy that, that toy or whatever it is that you want, that boat, RV, or whatever it is, right? Because the more the thing costs, the more commission that they can make off of you. Okay, so there are numbers that professional advisors and things will tell you to stick and stay within these parameters. And one of them is the 28-36 rule. 28% should you should not exceed 28% on your household. That includes your mortgage, your the mortgage, the insurance, the um, principal and interest on your mortgage loan, right? Not to exceed 28%. Presently, I just did the numbers where I was sitting at, and I'm sitting at around 12% on, my mortgage and the cost, everything associated with the cost of my mortgage, escrow, uh, taxes, insurance, and stuff like that. I'm sitting at about 12%. So if you exceed that amount, though, and you end up some kind of way stumbling over past the 30% mark, you get into the territory or the area where they call it, you become like, what I wrote it down. It's, the term is called, you become house burden. Yeah, house burden. That's a term that they use when I used to call it you're house poor. That's why I was looking for this new term that they use. I hadn't heard that term before until I looked it up. But I used to call it being house poor. In the book, The Millionaire Next Door, that was written some years ago, one of the things that they recommended in that book is that you don't buy a house or get a mortgage on a house or buy a house that exceeds 2 times what your annual income would be. So if you make $80,000 a year, they recommend that you don't exceed $160,000 for a mortgage, on a home, to purchase a home. So their recommendation is, and these are people that was following that, and in this book, all the people that they studied that were millionaires, and they said that you shouldn't exceed 2 times your annual income in buying a house. That's certainly the rule that I followed. I did not exceed 2 times what my annual income was at the time when I purchased my house. So therefore, like I said and mentioned, that when I did a calculation, my current household or house payment or house amount, monthly amount, does not exceed 12% of my monthly income. The 36 part of the rule takes into account or into calculation your house note, your mortgage, what you're paying for your household expense with that, and then your car, any personal loans, any type of car loan would also be considered in that 36% amount. Credit cards, revolving credit card accounts, revolving charge accounts would not exceed 36%. That includes your house now, right? That you shouldn't go over 36%. And here's a problem. I know a lot of times when people refinance mortgages, the amount that they initially refinance, right, that they financed at is at a certain percentage of their debt to income ratio. Well, you stay in the house for 5 years or however long it is, and then nobody's checking and looking. It's not like they looking every month to make sure that you don't ever exceed your debt to income ratio, right? And so many people then that they secured the house, and now money's cheap to borrow, they got a little loose with their pen, signing, on the dotted line to get stuff on credit, especially when you can use other people's money. And one of the things I think people need to consider is before you make any type of decision to sign your name on the dotted line to make an obligation like that, that's going to be something that you charge, that you should consider, you are spending money that you haven't earned yet, right? You're literally spending and allocating future dollars that you haven't earned yet to pay off a present debt. And so with that in mind, if you decide to refinance, then you need to really be careful and mindful that you don't stumble over if you change the terms of your loan and you end up getting, on your refinance deal, a payment that's higher than where you were at before, you just have to be mindful and careful that you don't stumble over that 28% amount and then end up stumbling over into the 30% or greater area on your household amounts, that you owe, your household obligations. So with that in mind, if you do exceed 36%, it's not the end of the world, right? For all of those things combined, your car notes, your credit cards, but it's certainly going to be tight if we end up going into a time like we are now, where inflation goes up and the cost of items go up because the consumer, the CPI index increased, and now the standard regular stuff that you would be buying, every day, we eat every day unless you're fasting for some reason, right? We drink water, people do fly on planes and they do stuff like that. Maybe I should bring that back up again. Let me bring that back up again. So you're looking at, regular stuff that we use every day. Fruits and vegetables increasing 7.8%. Meat and poultry increased 14%. Used cars, 22.7%. We saw with the pandemic, and someone were talking about they couldn't get chips and things for the vehicles, and so we start seeing a lot of cars not, we start seeing a lot of empty car lots. And then if you were trying to find a decent used vehicle, man, the cost of a decent used vehicle was up there and sometimes exceeding the price of a brand new vehicle. And nobody can deny the prices that we've been seeing at the gas pump lately, right? So you think about it. If you stretch yourself and you end up becoming house poor, and I probably shouldn't say that word, but that's why they eased, by saying house burdened. They eased, they don't want to just slap you over the head and say house poor because that sounds too harsh, right? So they gave you a softer term, house burdened, right? House burden, a softer term for just overextending yourself when you purchase your house. And then when you add up all your other debts and bills and stuff, then next thing you know, the price of stuff goes up, and now your household expenditures are now exceeding 40, 45, and 50%. Whereas the recommendation is to keep those same numbers under 36%. Then you accumulate other debts and stuff like that. It can happen real quick, fast, and in a hurry. So let me make sure that it's clear what I'm saying. If you're at a particular set point with your expenses, right, and you're comfortable there, and let's just say you already put yourself at the max, we're talking about the 36% mark on those items, right? And you're already up there near the max, right? Then once you get that secured and all of a sudden you start seeing that banks and credit unions and different lending institutions are offering these very, very insatiable, hard to pass up interest rates, and you've been wanting that motorcycle, you've been wanting to buy that boat, you've been wanting to get some snowmobiles and jet skis. So you go out and you sign the paper on the dotted line because they're freely given, so you freely receive. And now you're creeping over that 30% mark, you 37, 38%, and then all of a sudden inflation comes in. And those items that you was already over budget on becomes to be burdened with the fact that your daily cost of just daily items that you use every day, when you was just barely able to pay it anyway, those items increased substantially in the double digit area. And now you can't afford those loan payments, or if you do pay them, you're stretched to the max. So that's something to really be mindful of. Look, just because somebody says you qualify for something, that you qualify for the payment amount, that you qualify, look, I don't know why everybody's calling me now, that you qualified for that that amount on a house loan, you know, doesn't mean that you should max it out, right? And wisdom says that you shouldn't. Wisdom says don't max out what you qualify for, because the economy is a big circle. The economy is cyclical. The markets are cyclical. So you might be high now, but eventually things are going to take a downturn and there's going to be a correction, you know. And if you are already maxed out, then when the market takes a downturn and cost goes up, then what used to be a manageable situation becomes one that is very, very burdensome. So just because someone says you can qualify for something at a particular amount, because think about it, if interest rates are low, naturally that's going to make your monthly payment, low, and what some would say is affordable, right? Affordable. But then, like I say, here comes good old Mr. Inflation. So that's one of my biggest pieces of advice. You know, I know people want a nice fancy house. I know that and I get it. But if you're talking about building wealth, you have to keep yourself positioned in a place where you're not spending all of your discretionary income. You need to have something left over. And I think I saw one statistic that I shared in a video that me and my buddy Russ did, where there was a statistic that showed that the average American only had about 6% of their income left over after paying expenses and bills and mortgages and car payments and credit card payments and stuff like all of those things. So if you only have 6% of your income left over, you could just expect you're probably going to waste half of that. So I would venture to say that so many people possibly only have about 3% of their income left over every month after bills. And you're just not going to be able to substantially save and invest if you're not having anything left over, no discretionary income to work with. So now would be the best time to possibly consider downsizing on some items that you just don't need, that you were just maybe a little frivolous in buying, purchasing some things. It's okay to sell something, if you need to sell it and get it off your personal balance sheet. Now is a great time to do that. Now is also a great time to sit down as a family, if you're married or whatever, if you're not and you're single, to sit down, even with a professional financial advisor, to really take a look, a comprehensive financial plan, and look at your budget and where you're sitting with your monthly expenses, and do some hard code evaluating. And then once you do that, then the next step, set up a plan to begin to build up your cash reserves. Because what happened in the time that we were just in, I already know when you start seeing a bunch of stuff for sale that were not necessities to just being able to live and survive in the normal course of life, that a lot of times it's a pure, clear indication of not being leveraged, not leveraging your debts or your cash flow properly with the debt obligations that you have signed up for. So you want to leverage those debts, right, with cash reserves, with something that can be an underlying asset. Some people may call it collateral, but that's not what I'm referring to. Collateral. I'm referring to making sure that you have enough cash reserves on hand, or some other type of investments, or something that's an appreciable asset, something that you could possibly liquidate if things got tight, or that you could actually pay that debt completely off if you wanted to or needed to, right? So I think that's one of the issues and concerns that I would have, is in your monthly budget, make sure that you still budget in some type of savings, investments, your savings plan, and a cash reserve plan, because that way you can leverage your debts when we get into a market downturn and inflation rates. They all work in an inverted fashion. You'll typically see that if I put the inflation numbers side by side with the market data, you would see an inverted reaction. When the market is high, inflation tends to be low, right? Or unless we go into some type of deflation. If we go into some type of deflation, negative inflation numbers, then you can even then see the market potentially stumble. But also then when inflation and the CPI price index goes up, typically stocks and the market tends to stumble because people begin to get really tight on spending money, and that causes the market and a correction, and the market begins to stumble. So I hope that you got something valuable out of this. I know sometimes when I do the technical analysis type, market analysis type, videos, naturally, I expect that the numbers on the views might go down a little bit, because when you're talking about saving and investing, and you're talking about 20-year projections and 30, 40-year projections on being able to dollar cost average over that particular length of time to get up to a certain amount, for some type of retirement or whatever like that. All of that stuff is actually, it sounds boring. None of that stuff sounds sexy. It doesn't sound, alluring, and it doesn't woo you in and draw you in with sexy terms. Saying DCA, dollar cost averaging, that doesn't sound sexy. Talking about future value projections, that don't sound sexy. Talking about looking at the value of money from a futuristic time and bringing that value back into today's terms through, some type of what do you call it? Present discounted values. That stuff, that's not sexy. Don't sound sexy. Sitting down with a paper and pen and calculating your budget to pay off debt, that don't sound sexy. Sitting down trying to determine what you need to make adjustments for so that you can begin to save and invest at least a minimum of 10% of your income, that don't sound sexy. All of this stuff sounds flat out boring, but it is the stuff that is necessary, that you must do and have to do and should do if you're going to make sure that you can keep yourself at a stable place and not be hindered or put in a tight position if and when, because they're going to come back. These times always come back. In fact, let me share this real quick. Let me show you. I found a better chart for the historical data on the stock market. So I found a better chart, and in this chart, I hope you can see it really good. You might have to put your glasses on. Let me see. Should I switch over? If I switch over screens, and I might make a mistake and do what I did last time. Then you'd be looking at a totally complete dark black screen. So this is once again showing historical data going all the way back to somewhere around 1914 in the stock market, and looking at the times when we had losses and looking at the times when we had gains. And I've shared this chart before, but as you can see, this was the heavy downturn right there in the 1930s, the area when we had the Great Depression. And it shows that, numbers dropped, there was in 34 months, there was negative 83% plus losses. But then after that, we had 167 months. It was roughly close to 14 years of total annual returns of 815% with annualized returns of 17.2%. So you can always see where even when we had downturns in the markets, really bad times, look over here for 16 months, we had negative 50% losses, around the 2008 time period when we had the housing bubble issue, right? 50% plus losses, for 16 months, for a year and a half, almost a year and a half. But then after that, we had annualized returns for 61 months of 183 annualized returns. And did I say annualized? I'm sorry, cumulative returns, total returns, 183%, and then annualized returns of 22.8%, 22.8%. So you can see, historical data shows us that whenever there's a stumble in the market, a correction, whether it's a bear market or even a recession. You know, those two times that I just mentioned, those were definitely recessions. You know, the Great Depression, you know, back in the 30s or whenever it was, and then, you know, 2008 in that time period when we had what was called the Great Recession and negative 50% losses. So, but you can see the blue, and after all of these downturns, the market comes back. Because think about it. Let's make it real simple. Think about it. We can't sustain those type of high inflation numbers. You know, you saw a time when it was what 3 years back in the early 80s where we sustained 3 years of 3, 4, 5 years of negative. I mean, really high inflation numbers, right? You know, we can't typically sustain those type of high inflation numbers. Eventually, the Federal Reserve, which they have done now, will begin to raise interest rates, and we've gotten more sophisticated now than we were back years ago. We've learned from those very difficult times, financial times, and they've developed now safeguards and different ways, you know, of managing things and, you know, studying and being able to determine how they can raise interest rates or do whatever they got to do, start buying things. You know, now we got this way that the Fed does quantitative tightening and stuff like that, where they can go in the marketplace and begin to buy back from banks some of the government securities and different things, corporate bonds, all types of stuff like that. So we can see that the Fed has gotten more sophisticated, and so they'll raise the interest rates. They'll monitor things. They'll see on July 13th, you know, what the CPI numbers, index numbers turn out to be. You know what inflation is looking at that time, and then they'll make another adjustment. Like I say, I suspect that it will be at least a minimum of 50 basis points, probably 75 more basis points, right? And then you can look for the banks, whatever they're lending out is probably going to be possibly, I've heard somebody say maybe another 1.5% over that, you know, whatever that would be. I don't really know. But, you know, to make a long story short is we can't sustain, you know, high inflation numbers for a long period duration of time, right? You know, the whole purpose of the Fed, you know, and everything, and hopefully the government and our politicians is to try to keep a healthy economy. Certainly the business world, you know, the private sector, the private market and stuff like that, they are incentivized because they don't make a profit in times, you know, they will raise prices in order to keep their profit margin ability there, right? Which is what we see. But we can't sustain high inflation numbers for a long duration of time because it doesn't afford us to have a healthy economy when that happens. And people, you know, they want to make money in the business sector. So they're incentivized to make sure that things happen, you know, and they will lobby for change or whatever needs to happen so that they can continue to make a profit, you know, through their in the business sector. So I don't see maybe there's some people that I've convinced, maybe not, but I don't see where we're headed for a total collapse. You know, in spite of some doom and gloom people and people that's saying that, you know, the economy is about to take a dumpster dive and the stock market is about to bottom out, the bottom's about to fall out. But thanks for watching this video. If you have been watching via YouTube live, hey, you know what to do. Press that subscribe button, press the thumbs up, a like button on the video, and also drop some comments below in the comment section and ring that bell if you've been watching here on Facebook on my personal page. Hopefully I've said some things. Like I say, this type of content, some people just tend to think is boring when you're talking about analytical data and stuff like that. Some people tend to think that it's boring. I even do sometimes myself. But hey, one more thing before I go. Look, hey, learn how to read charts. If you're investing in stocks, long-term, short-term, or dollar cost averaging over time, whatever the case may be, day trading, short-term trading, learn how to read charts, right? So you can know what your support points are, learn what those are, and you can begin to start reading the break points so you can tell if a stock or the market's going up, you know, about to take a dumpster dive and correct itself and go down. Learn how to read charts so that you're not walking into an investment blindly, you know, with one eye closed and can't see out the other. Learn how to read charts. It's very important because literally the professionals, the people that's been doing this a long time and a while, they can read charts. Now, they may tell you one thing that something's about to happen, but they can read the charts. And the bigger firms, these bigger firms, some of them have set up systems, computer systems and programs that run on algorithms that when they see certain chart activity, they actually have sell points. They have stop limit orders that are programmed uh, at certain set points when they see certain items or things that happen with the particular investment. And so they have stop limit points, and this algorithm will be able to analyze those set points and it begin maybe to sell a certain percentage of that portfolio based on that algorithm hitting certain safeguard points or stop limit points. And if you learn how to read charts, then you can begin to set up some stop limit points on your investments. Now, you can't do it with crypto. I've already did a video on that and why I'm skeptical. And personally, I don't want to fool with it until there's some type of regulation that comes. But in the regular markets and regular stocks, you can set stop limit orders and things like that. So if you are concerned that your investment is about to maybe go down and decline and decrease in value, that stop limit order will protect your profits at whatever price you set. So it's just a number of things that you can begin to do to protect your investments or your profits from things that you earn, in your investments, so you can get better rates of return, right? Because investing is all about trying to make a profit, and you want to make that profit, you know, as beneficial and substantial as possible, right? So learn how to read charts. I mean, that's if everything else has been boring today, maybe that'll make you excited. Learn how to read charts. Learn how to read breakpoints, support points. Learn how to read peaks and valleys and mountains. Learn how to read charts so that you can better go into an investment with a strategy. And in my previous video, I mentioned that you need to develop about 5 different strategies that you can use for different type of scenarios or economic conditions and things like that. So once again, if you've been watching this video on my personal Facebook page, thanks for watching. Press that heart button, thumbs up, like button, share this video, and watch this video more than once, because oftentimes when I do like a technical analysis or market type analysis video, you're not going to really get everything and maybe hear everything the first time you listen to it. So maybe listen to it a second time around. Also, if you do watch this video on the Working Man's Podcast platform here on Facebook, then also do the same. Press the heart button, press that thumbs up, like button, share this video, and drop some comments below. Thank you once again for watching. It's been James Hollingsworth on the Working People's Podcast, where everybody desires to build generational wealth and financial legacy for their families. Thanks for watching, but y'all know I got to go. So I'm out.